What if I told you the biggest move in silver history hasn't happened yet, but the pressure is building right now? Imagine waking up one morning and silver isn't $25, not $50, but racing toward triple digits while Wall Street scrambles to explain what just happened. Some analysts are quietly warning that the silver market is sitting on a coiled spring, and if it snaps, the move could be violent, fast, and completely out of reach for the average investor. Today we are talking about the growing whispers of a $500 silver scenario, the role of massive short positions, and why voices like Willem Middelkoop believe a historic squeeze could be closer than most people think. Before we dive in, if you want straight-talking insights on gold, silver, and the forces shaping the global economy, tap like and subscribe to Wealth Signal right now. It really helps the channel, and it means you won't miss the next big warning signs before the crowd catches on. Silver has always been the quiet cousin of gold. It doesn't get the same headlines, the same central bank attention, or the same respect from mainstream finance. But under the surface, silver is a completely different animal. It's not just money, it's an industrial metal used in solar panels, electric vehicles, electronics, medical equipment, and military tech. That means silver demand doesn't just depend on investors being scared. It also depends on the modern world functioning, growing, and electrifying. And right now, global demand for silver in industry is hitting record levels while supply struggles to keep up. Here's where things start to get interesting. For years, the silver market has been known for having unusually large short positions held by major financial institutions. A short position means you're betting the price will fall. But if the price rises instead, you can be forced to buy back at higher and higher prices to limit losses. That buying pushes prices even higher, which forces more short sellers to buy. That chain reaction is called a short squeeze, and in a small market like silver, it can turn into a price explosion. One name that often comes up in these discussions is JPMorgan. Over the years, JPMorgan has been linked to massive activity in the precious metals market, including both physical silver holdings and derivatives positions. While the bank doesn't publicly spell out every detail of its strategy, market watchers have long believed that a few big players hold outsized influence in silver futures. The concern isn't just that they short, it is that the size of those paper positions may be far larger than the actual physical silver available for delivery. Think about that for a second. If too many people hold paper claims on silver, but not enough physical metal exists to back them all, the system works fine as long as most traders settle in cash. But if confidence drops and more investors start demanding real metal instead of paper contracts, the pressure builds. Suddenly, the shorts may have to scramble to find physical silver in a market that's already tight. That's the kind of environment where prices don't move slowly. They gap higher. Willem Middelkoop, a longtime precious metals investor and author, has warned that the precious metals market is structurally fragile. His view is that we're reliving through a long transition away from a purely dollar-dominated system toward a more multipolar world where tangible assets regain importance. In that kind of shift, gold leads, but silver can outperform dramatically because it's smaller, more volatile, and more heavily used in industry. Middelkoop and others argue that when the revaluation finally hits, silver won't just drift up. It could reprice in a way that shocks the mainstream. Now let's talk about that bold number, $500 silver. Is that a prediction? Not exactly. It's more like a stress test scenario. If you adjust silver for inflation from its 1980 high, the number is already much higher than today's prices. If you compare the historical gold to silver ratio during monetary stress periods, silver often outperforms gold by a wide margin. And if gold were to move into the several $1,000s range in a serious currency crisis, a compressed ratio could mathematically push silver into the hundreds. It sounds crazy only if you assume the current financial system stays stable. History suggests that assumption doesn't always hold. At the same time, governments around the world are drowning in debt. The US alone is running massive deficits year after year, and the only politically acceptable solution seems to be more borrowing and more money creation. When currency supply rises faster than real goods and services, purchasing power erodes. People may not notice it all at once, but they feel it in groceries, rent, insurance, and energy. Precious metals have traditionally acted as a pressure valve in these environments. They're not someone else's liability. They can't be printed. And they tend to attract capital when trust in paper promises starts to fade. Here's where the short squeeze angle connects with the macro story. If investors begin moving serious money into physical silver as a hedge against currency risk, they're not just buying an asset. They're pulling metal out of the available supply. That tightens the market even more. Industrial users still need silver no matter what the price is doing. Solar manufacturers can't just switch to plastic. Electronics companies can't remove silver from circuit boards overnight. So you have financial demand rising at the same time industrial demand stays strong. Meanwhile, new mine supply is slow, expensive, and often tied to base metal production, not pure silver mines. If a large short position is sitting on top of that structure, it becomes extremely vulnerable. All it takes is a strong, sustained rally to push those shorts into defensive mode. First they hedge, then they cover, then they panic. And because silver is a relatively small market compared to stocks or bonds, even a few $1 billion of aggressive buying can send prices flying. That's why silver moves in bursts. It sleeps for years, then runs like it's on fire. But let's stay grounded. Markets are complex, and timing is the hardest part. Silver has frustrated investors before with long periods of sideways action. Big institutions have deep pockets and sophisticated strategies. A squeeze, if it happens, might not be clean or immediate. There can be sharp pullbacks, fake breakouts, and sentiment swings that shake people out before the real move unfolds. That's why understanding the bigger picture matters more than chasing every daily price tick. For long-term thinkers, the question isn't just will silver hit $500 tomorrow? It's what happens to tangible assets in a world of rising debt, geopolitical tension, deglobalization, and currency debasement. If even part of that risk shows up, silver doesn't need to reach $500 to be a meaningful hedge. A move to $50, $100, or beyond would already represent a major shift in how markets value real assets versus paper wealth. Another factor to watch is investor psychology. Most people don't care about silver right now. It's not trending on social media every day. Your neighbors aren't bragging about their coin collections. That's usually how big moves start, in boredom and disbelief. By the time mainstream media starts running stories about a silver shortage or a historic rally, a large part of the move may already be behind us. Early phases feel slow and lonely. Late phases feel obvious and crowded. This is why education is so important. At Wealth Signal, the goal isn't to create hype. It's to connect the dots between global trends, market structure, and historical patterns so you can make informed decisions. Whether silver goes to $100, $200, or something far higher over time, the key is understanding why the move could happen, not just hoping for a lucky break. As we move deeper into this decade, keep an eye on a few signals. Watch physical silver premiums over spot prices. Rising premiums can indicate tight supply. Watch central bank behavior in gold, because strength there often spills into silver later. Pay attention to industrial demand trends, especially in solar and electric vehicles. And listen carefully when experienced voices like Middelkoop start sounding more urgent than usual. They've seen cycles come and go, and they know how quickly sentiment can flip. We may be heading toward a period where the rules people got used to over the last 20 years don't work the same way anymore. Easy money, low inflation, and endless faith in financial engineering could give way to volatility, currency questions, and a renewed interest in real, tangible assets. In that kind of environment, silver is not just another commodity. It becomes a strategic metal with monetary history and industrial necessity wrapped into one. If a true short squeeze unfolds on top of that backdrop, the price charts could look surreal in hindsight. Straight lines up, gaps higher, analysts rushing to update targets that seemed impossible just months earlier, and regular people asking, why didn't I look into this sooner? So the big takeaway isn't to panic or go all in overnight. It's to stay aware, understand the structure of the market, recognize the risk that paper promises can break under stress, and consider how a small, often ignored metal like silver could play a much bigger role in the next phase of the global financial story. If you found this breakdown helpful, drop a comment below and tell me your silver price target for this cycle. Do you think triple digits are realistic, or is $500 pure fantasy? I read the comments, and your perspective helps shape future videos. And if you know someone who's worried about inflation, debt, or where the economy is headed, share this video with them. These conversations matter, especially before the crowd wakes up. Thanks for spending your time with Wealth Signal. Stay sharp, stay curious, and I'll see you in the next one.